with Jeff Barton, your voice in the mortgage industry. Each week on this program, Jeff and his guests share their expertise, personal anecdotes, and the latest industry news to keep you in the loop. Now, to provide you with insight and help you navigate the consistently changing world of real estate lending, here is your host for the Mortgage Voice, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton. This is the Mortgage Voice, and I thank you very much for listening to the show. This, in each and every week that you do listen, we bring to you information that you can use upon either your mortgage refinance or your mortgage purchase out there. Now, one thing that's happened in the mortgage market the last couple of weeks is we've seen rates decline a little bit. The 30-year fixed rate today is 6.49, 5.90 is the 15-year, 6.12 is the FHA, 6.34 is the 30-year jumbo, and 6.76 is the 5/1 ARM. Now, those may seem high in some respects. Yes, I guess they are, but it's not 7.5, which they were not all too long ago. If we see these interest rates continue to fall, let's say we get down into the 6.25% for the 30-year fixed rate on an average loan that you're going to get for a house purchase. That is pretty good, and we're going to see a lot more people jump back into the market. We'll see a lot more contracts out there. We've seen contracts for sale actually fall over the last quarter. Not a great sign. And part of the things that we're talking about both today's show and throughout the first quarter of the year was what is going to happen in the real estate market, what is going to happen obviously to the mortgage market. Anytime the mortgage rates go up, we see less and less homes on the market and fewer buyers in the market. So interesting. Some other things that I wanted to get to: the 2-year is at 3.90 and the 10-year is at 3.39. Now, if you go back into the archives, go to KCAA, look at the archives there. They do a great job of housing the past programs, or you can go to YouTube, Jeff Barton, the Mortgage Voice on YouTube, and you can hear and see how the progression of events over the last year, if you listen to these shows, and how the interest rates have really affected not only the psychology of buying, but the actual fact of buying. If it's costing you another $1,000 a month just because rates have risen 3 points, 4 points, 5 points, whatever it might be, you're going to reconsider your purchase. Now, certainly, we still have plenty of cash buyers out there, and we do. 25% of the market out there is still cash buyers. But that's normal in the Inland Empire and the Southern California markets. We see a yo-yo in prices over the past 10 to 20 years, but this year alone, we've seen prices increase by 3 to 5% in all of these areas, San Bernardino, Riverside County specifically. Now, why is that? Well, one of the reasons is we have such a scarcity of product on the market, and that interest rates, when they got into the 2.3 to 3.3% rates, nobody wants to refinance or sell those particular rates out from under them, and nobody is putting new product on the market. I mean, there is some new product, but not to the tune of making more and more houses available. So both of these things in conjunction make real estate prices stay as high as they are, and I think they're going to continue to stay high. I was predicting a little bit of a recession. I was predicting a little bit of prices coming down. We were worried about, what's going to happen to the shadow inventory when we get all these foreclosures. Well, it never happened, and one of the reasons it didn't happen, delinquencies are falling. Delinquency rate in the first quarter of 2023 is 3.56%. Of all loans. That is incredibly low. 1.77% of the first 30 days are those in delinquency. So when you're considering, you're out there right now, you want to buy a house, and you're saying, hey, maybe we'll see some retrenchment in prices. Maybe we'll see rates come down. I think you'll see rates come down a little bit. Is now the best time to get into the market? Well, we bring guests onto the show, and each and every week, every single one of them, now granted they're in the business, so take it for what that means, but each and every one of them says, hey, look, if you can afford the monthly, get in the market now. The reason is, if rates fall in the future, 6 months from now, you can refinance. If rates don't fall, but prices increase, you're gaining equity as soon as 6 months to a year. We're still seeing, as I said, 3 to 5% increase in prices each and every year, and have been for the last couple of years. Previous to that, before COVID to today, 20% you've seen your house price increase or your house value increase. So that's pretty impressive. Let's get to a couple other things. The debt ceiling. Yes, we talk about the debt ceiling so much. You know, back in 2013, there was a big hubbub about the debt ceiling. What is the debt ceiling? How does the debt ceiling work? Why is it important to you who are just going to work each and every day, paying your bills? Of course, you can't have a debt crisis. You can't say, hey, you know what? I don't want to pay my bills. Well, you can, but you got to get bankrupt. And in order to get bankrupt, you got to go through a lot of hoops, and you got to go through court, and you got to prove that you can't pay your bills. Well, the U.S. about to decline on their particular debts owed, $31 trillion. That's right. If you stack those bills on top of each other, you'd go to the moon and back about 25 times. It's just an incredible number, not really real to most of us who each and every day have to pay. Oh, by the way, egg prices down 37%. So if you're one of those people who are decrying the inflation, we'll get to that a little bit later. But in terms of the debt ceiling, yeah, that's what it is. Now, I have some information about the debt ceiling, and one of the things that, 4 things about the debt ceiling that's kind of important to you, important to me, and here they are. Okay, the standoff continues. Yes, it does. That's number 1. The partial default, which is kind of on the table, retirees, military, veterans, contractors, they're not going to get paid. So if you're out there and you're in that group, call your Congress people, okay? Because they're the only ones that can get this thing done. One way or the other, I don't care. The bonds, yes, they will be repaid. So there's 5% chance, according to this particular article I read, that that's the solution. Number 2, clean debt ceiling. That's the Biden administration's answer to every problem. Let's just pass it. Pass another debt ceiling. Okay, let's just keep upping the bill. Now, I'm not for or against it, but that doesn't seem like a corrective, a very good strategy either. And there's only about a 10% odds chance that that's going to happen. Biden caves, i.e. he's going to negotiate debt. Well, that doesn't seem like that's going to happen either. However, 20% odds on that. That's 1, 2, 3. Standoff continues 1. Clean debt ceiling 2. Biden caves 3. Number 4, which seems to be the consensus of this particular article as to what will happen, we'll kind of punt the thing down the road, negotiate the debt through the budget for next year. Let's see, debt ceiling suspended. Yes, that's right. They just suspend the debt ceiling, keep raising it without ever having to raise it to a number until they negotiate the thing out. Suspend the debt ceiling for a longer period of negotiations, done several times between 2013 and 2019. Now, in those years, 2013 to 2019, we saw a lot of push, like we're spending too much money. We've got to save the veterans. That's on one side, spending too much money on the other side. This is a very similar event. However, if you are paying attention over the last 30 years, whatever, depends on who's in power. It all becomes a political game. And the fact is that both parties spend too much, and both parties are only interested in one thing, staying in power. And both of those things don't help you get a mortgage. Getting a mortgage is really dependent on being able to trust that you're going to pay your bill, period. That's just period. That's how America works. You take a debt, you pay their bill. I don't care what it is. The biggest debtor in the world is the U.S. government. They've borrowed $31 trillion, have never defaulted on any debt they've owed. Now, is that important? Sure, because if they default on this one, you're going to see the lending criteria really tighten. You're going to see interest rates climb heavily, and you're going to see a lot of services that were available to you from either your local, your state, or your federal government go away. And all of these things are going to be a result of parties, whoever they are, not getting together and making this thing happen. The long run is it's going to hurt you and you getting a mortgage and you buying real estate if this thing doesn't happen. I would say call, write, email, text, however you do, just make sure that these people understand that you're the one going to be hurt both buying a house and refinancing a house. Anyway, I'm Jeff Barton. I'm your voice in the mortgage industry. Really appreciate you listening to the show, and we'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning into the show. Each and every week, we bring to you some terrific information about mortgages, about sale of properties, about opportunities. A lot of it has been doom and gloom this year, I can't lie. And so each and every week, we try to come on and cheer you up. But this week, unfortunately, we've had a number of things that might affect mortgage rates, might affect the economy overall, as we talked about. We've got certainly inflation, which has been around. We've got the war, which has been around. Both these things weighing heavily on a number of things worldwide. But also, we've got this debt ceiling thing. And again, we've talked about it earlier in the show. However, we do have great guests. And one of them is with us right now, Chris Burkett, who has never been on the show. He's from Next Us Mortgage and joins us now to give us some solutions as to products, availability in the market, and what they're offering. Chris, how are you?
I am wonderful. Thank you for having me on the show.
Thank you very much, too, and I do appreciate it. We have a very fast-paced kind of hour that we share on a weekly basis, and you joining us is a real plus. Thanks again.
Welcome to be here.
Okay, great. Tell us something about Next Us, if you would, please. I know it's a company that Malibu Funding, the company that sponsors the show, has been with for a number of years, but tell us what kind of niche you do, what kind of products you offer, things like that.
Sure. Yeah, our niche, we're basically a non-QM lender.
Okay.
We're not technically doing any A paper, but we do some A paper, full doc jumbo stuff, because we'll go up to 55 back-end DTI, depending on the loan to value.
Okay.
It kind of falls out of the realm of A paper. You know, we'll do $2 million, $3 million loans, but I do a lot of 12 to 24-month bank statement loans, P&L loans, DSCR, debt service coverage ratio for non-owner occupied, which are basically business loans, and asset depletion. And then we do a lot of seconds, closed-end seconds now.
Okay.
Many have already refinanced, have anywhere between 2.5% to 4% on their first, which they don't want to disturb.
Right.
And so we're doing a lot of seconds, closed-end seconds right now in our HELOAN program.
Okay, so it sounds like you're actually solving a lot of problems. People have equity in their home but don't want to get rid of the low interest rates, so you do a second. How are you? Is this just a straightforward standalone second? How are you blending that with the original rate? What are you doing in order to satisfy those constraints that you have with the people that you sell the loan to?
Sure. We have two programs for the seconds. We're doing full doc and 12-month bank statements. Those are the two programs. On the full doc, you can do a 1-year W-2 with pay stub or a 1-year tax return or a 1-year 1120. We'll go up to a 50 DTI.
Okay.
And then in our pricing engine, when you can put in the first trust deed and the rate, and it gives you what's called the blended lien rate.
Uh-huh.
And on average, that's coming between 4.5% to 5.5%, which, unless you can get a first trust deed with cash out anywhere in between there, which I don't think you can in this market right now.
Nope. That's
why the second behooves them. And there's no prepay on the seconds either.
Oh, that's
so we can
excellent.
do non-owner second
Right.
and owner occupied.
Okay, so that sounds like a very in-demand type product, i.e. like I say,
very busy with it right now.
Right, exactly. And are your company based mostly in Southern California, or are you a national company?
We're a national lender.
Okay.
We're approved in probably 40 states now.
Okay.
And I can do DSCR or other brokers that aren't approved in some states can do DSCRs in those states because they're business loans. I have a list of states which you still need to be licensed, but some of those states you do not, like Colorado, for example. You could do a DSCR loan there. You can do a DSCR loan in Texas, and you don't have to be licensed in Texas.
So most of our people that listen to the show are consumers, and I appreciate the information for brokers to take advantage of a program like that. But let's say you're in a different state or even in California and you want to get going on something like that. Do you go through a broker? Do they call you directly? Or do you guys do wholesale, or are you mostly retail? What do you do?
We're strictly pretty much wholesale. They are starting a retail division.
Okay.
Thomas Yoon just came in, and I believe he's starting to do some retail. But anybody that's looking for a broker, we can in another state other than California, we can help find one for you that can submit to us at Nexus Lending.
Earlier in the show, I talked about Loan Depot, Guild, United Wholesale, and Blend all having really ridiculously terrible first quarters, losing millions and millions of dollars. And in this lending environment, I think what we're all looking for as consumers, or as the voice of the consumer, is somebody that we can rely upon, somebody who's going to be there, has been there, and will continue to be there throughout, not only the loan process, but through the servicing of the loan, if in fact you guys do service. How are you guys backed up, and where's your particular backstop, your funds?
Correct. We have really deep pockets behind us.
Okay.
One of the largest hedge funds on Wall Street, fourth largest, by the way.
Okay.
We have great financial backing. One of the things our leader, Bill Ashmore with Vista, which is our parent company, Bill saw a lot of things coming early, and he raised rates, way ahead of most of the other competitors out there.
Right.
And, we saw some lenders had fallen, and,
of course.
just they stayed too low too long, and they got hit hard, But we have somebody good at the helm, and we've been around for a long time. Bill has, I have. I've been in the business for 35 years. So.
Oh, I'm sorry to hear that.
One of the reasons why I'm still here, and they know what they're doing.
No, that's.
So we'll be around. We'll be one of the few to stick it out and get through it.
No, that's excellent information. Not only that, because how people are, they want to go with a secure company, and
yes.
Because the big box banks really don't do wholesale anymore. They don't go out there and reach out to anybody who is not a bank depositor. It's really hard to find those type of companies that have the secure funding in order to last out there in the marketplace, especially in the non-QM space, which seems to, harbor a lot of ill feelings, especially since the subprime market back in the 07-08 days, which of course non-QM is not that, but to the consumer who does 1-2 loans a lifetime, they're not quite aware of that. Okay, so you mentioned the bank statement loans, the two different products that you have. Can you just give us a little bit of a rundown as to the differences between the two?
Yeah, we have the P&L and a 12 or 24-month bank statement.
Right.
You get a little bit better pricing on 24 months as opposed to 12 months. It just gives a longer look back on the borrower and his business. A P&L, we require it to be on a CPA letterhead, CTEC, an EA enrolled agent, one of those three, and whatever they put on that P&L, that's what we're going with. We're not questioning just has to make sense based on the business as well. If it's a service or product related business,
right?
Based on the expenses that they're putting on that profit and loss.
Okay, interesting. Now, the profit and loss used to be called a liar's loan. What differentiates it today from what it was back in the day?
Yeah, well,
right?
Are you talking before 2008?
Yeah, right.
Yeah, I'm glad we're not doing that anymore.
No, I agree completely, but I think some people like to be reassured.
Yeah, these loans today, they're performing. That's why even though rates have gone up, much higher, these loans perform. We can see the cash flow going through on the bank on a bank statement loan. You can tell the business is doing well. We're just not seeing what he's writing off with Uncle Sam.
Right. Interesting. You talked about income and how you calculate it, obviously, and what you look at in terms of calculating that income in a borrower's loan submission package. Where do you see the economy? Where do you see some gaps that might be a little bit of a problem qualifying somebody? As certain industries might not be doing well, or certain particular jobs that you question more than others?
No, the numbers speak for themselves.
Okay.
There's a lot of industries that are, obviously suffering right now.
Right.
Our industry being one of them.
Right.
But, the numbers speak for themselves. We have to prove ability to repay, ATR.
Right.
We have to show that. That's the difference today as opposed to prior to 08 and the financial crisis. You can tell these people can afford to make this payment. That's the purpose of ATR, and we have to show that in all our loans. And we get QC too,
Oh, of course.
We actually, So, they're performing. These loans are good quality loans. So, sometimes
Excellent.
people run into problems like it's expected. That's the purpose of why rates are higher right now. They're trying to slow down the economy to bring down inflation.
Right. No, I totally agree. Listen, we're run up against it. We've done about 10 minutes. I really appreciate you coming on the show. Information is great. Want to have you back. We get a baseline here today, and then in the future we'll see where we have come from today's interview, and I really appreciate you coming on the show.
Yeah, no, I thank you for having me. I appreciate it, Jeff.
Thank you very much. You want to shout out a number or a way by which people can get it?
Chris Burkett with Nexus Lending. My phone number, 818-486-8608. That's 818-486-8608.
Chris, again, thank you for coming on the show. Really appreciate it.
You bet, man. Thank you for having me.
Thank you. That's Chris Burkett from Nexus Lending. I'm Jeff Barton, your voice in the mortgage industry. Be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning into the show. We want to get to the guests right away, but first off, you can see this show in a number of different ways. We shoot this for YouTube, Jeff Barton, the mortgage voice. You can see this as well as many, many shows that we've done over the last 4 or 5 years, 6 years that Daryl and I have been working together that shows you a historical perspective of when rates were a certain high, now they're a certain high again, but in the middle they were really down. But the show and how it proceeded through the years really gives you a good chronicle of exactly what the mortgage industry is, the products available, and those people that can help you the most. So if you want to go to The Mortgage Voice, Jeff Barton, The Mortgage Voice on YouTube, you can see all that. We also have a great website at themortgagevoice.com. You can see the guests. You can contact the guests. You can hear the show as well. Anyway, thank you very much. I am Jeff Barton. This is The Mortgage Voice. Okay, Charles Giscombe joins me again. We were just eagerly talking NBA basketball, and I want to make the leap from NBA basketball playoffs where what you're looking for in consistency and excellence in performance on a nightly basis is kind of what we're trying to experience in the mortgage industry. I'll just quickly go through it one last time. This month, Loan Depot, Guild, United Wholesale, Blend, all having the worst months or quarters of their particular company over the last 10 years. There are many, many, many mortgage companies and mortgage bankers as well as other types of ways that you can get a loan that companies are hurting. So how do we get, Charles, and welcome to the show, by the way.
Thank you for having me.
Thank you.
Jeff. Appreciate that.
How do we get consistency in the marketplace, especially when you're coming to a company like Malibu Funding? Like somebody calls you up, okay, I need consistency. I need your best game right now, and I need it, for months to come. How do you deliver that?
Well, at the end of the day, I think the most important thing is truly sitting down and digging in and doing your due diligence and finding out who the client is and who the borrower is. I think the most important thing is taking the time to find out, not trying to squeeze them into a box, but really finding out what their financial structure is, who they are as a borrower, as a client, what they have that is strong, what are their shortcomings, so we can help fill those gaps. Once we understand exactly who we're dealing with and what we're dealing with, then it is easy for us as loan professionals who do this every day to understand what particular programs and products are out there to meet the need of the individual. I think the way you stay consistent is always doing your diligence and being up on every product that can help right now, especially for the market as it's wavering. If you understand that, you can meet the two, put them in together, and kind of tailor fit and structure a financial and mortgage structure for the individual that will make them qualify. That way we don't waste time looking at stuff that they can't get into, but we're more consistent on dialing in onto what it is that they actually need, what they can provide, and how we can paint the picture to get them qualified for a mortgage, Jeff.
No, I think that's excellent information. And it led me to thinking, okay, so I've got a client and they want a certain rate for a certain product when they may be totally different answers. For instance, if you're looking for rate, you got to go this way, but you don't qualify. How do you get the borrower to understand it's better to get into the property in this type of program, even though the rate is higher and you'll refinance later, than to try to squeeze into something that you really don't qualify for?
You know what, Jeff? That's a great question and well put. The way I view it is I always have to do a history lesson with whether it's a new client or a returning client. I always do a history lesson and let them know this is not the first time that the industry has been like this. It will not be the last time, and it is consistent. The most important thing right now is acquiring the property. That will allow you to have more leverage in a situation. One thing we do know is that whether the rates are currently going to last this long or another 24 months, whatever it is, it will change. They will come down. So the key to it is letting them know the history lesson ahead of time, and that's also knowing as a loan officer what the history is and what the trend is, and then letting them know these are the programs that we can get you into. Of course, the objectivity is not to stay in a loan with a high interest rate, but it is to get into the industry, into the market, get a property that has a value, because eventually what will happen is when those rates go down, you still may be in an appreciating market. So even though you have to adjust and make that strategical adjustment at some point, you're still in the game gaining, filling up your piggy bank and getting equity. I think that if you can explain that to the client, you might have to do a little bit backwards before you go forwards. But at the end of the day, making them understand that will give them a better idea of what a strategy collectively is so they can feel more comfortable and trust you moving forward.
You know, over the last 2 weeks, we've actually seen rates come down, albeit slowly, but they are coming down. We've got a 30-year fixed rate quote today at about 6.5%. When is it that we get comfortable with the rate enough that we're not talking rates anymore? Is it high fives, mid fives? Where do you think?
Jeff, I always start my conversations out with every client that I get into and say, no one has low interest rates anymore.
Right.
Let me be clear with that. Once we have an understanding that there's no more low interest rates and that the all-time low, it does not exist and probably won't go back there again.
Right.
But it'll get close. Once we do that, then we say, listen, right now, 10 years ago, a 7, 8, 9 was a good interest rate.
That's right.
So we're in a good position right now. I always tell them, if you're in 6s and 7 range, you're still consistent, and it will go down from there. But I always explain to them not to look for the lowest interest rate, because the lowest interest rate is going to cost you the most money. Once you explain that to these individuals and they understand that it's going to cost them more to get into it, now we go back to that strategy plan that we talked about and saying, if we can get something in the comfortable 6s, even high 6, low 6, high 5s, it's a great deal to get into right now because we can immediately readjust, re-strategize, and adjust down once the rates change. I always explain that first. But as far as comfort level is concerned, Jeff, you know what? A 6.5, a 6.875, you know what? It's what it is right now. It's the trend, and it will come down slowly.
No, I agree with you, and I like the explanation. It's a confidence of knowledge from not only historical analysis, but also on the realities of where the market is. I mean, like you said, this particular number, 6.5%, whatever it is really historically a pretty low rate. I mean, if you go back 20, 30 years, you're going to say, hey, you know what? This isn't that bad. We're just so used to this other thing. Okay, so I want to get into products. What are you seeing in the marketplace? I assume we're talking non-QM in the most part to what you're going to be offering your clients, especially in this environment where you're trying to fit the best fit for them into the credit box. What products are you selling?
You know what, Jeff? We're still, you obviously can't get away to the Fannie, Freddie, Ginnie. Those are the traditional mortgages. You can still get those done. Folks, if you have that financial documentation and your paper trail is good, it's always a good loan to get into still. That's where you're going to get your lowest interest rates in the market. If you don't meet that box or you can't fit into that box because you don't have the consistency of employment or your documentation is not there, the non-QM realm that Jeff talked about is absolutely a way to go. It provides you an opportunity for those individuals who don't have that paperwork. It gives you alternative options and document providing that you can provide, as opposed to W-2s, tax returns, paycheck stubs, bank statements, profit and loss statements, CPA letters. Those are all things that you can get that will justify your income, show that you have the ability to repay, our favorite initials, ATR. And at the end of the day, once you can provide that, these loans will get you into your home with a little higher interest rate, but it absolutely is the path of least resistance. It allows people who know or are worried about their financial structure to worry less in qualifying for a home.
That's exactly. I think the point here, and what I said earlier on the show is, we try to focus on what's your goal here. You're trying to get a house. You're trying to move in. Your new family. You're relocating. You want to downscale. You want to upscale. Whatever the goal is, that's the major thing to continue to focus on. The monthly, yes, that's obviously secondarily important because you have to come up with the mortgage on a monthly basis. But for the most part, if your goal is to home ownership, you want to get into that house, how can we get you there? And I think that's the product you're going to put them with.
Absolutely, Jeff. I always look at it now, especially in this market. I always say to my client, let's look at it like this. Forgiveness is better than permission.
Right.
It means you're in the property already, and now you already have done the most major thing, and that is the acquisition. Now you're in a leverageable position. Your interest rate may be high. But in the non-QM realm, Jeff, there's many things that we can do to offset that higher interest rate. For example, non-QM loans, even at 90%, 85%, 80%, don't have any mortgage insurance.
Right.
So you don't have to pay the mortgage insurance that you would normally have on a traditional loan. Okay? On top of that, now when you don't have that, you're taking down a substantial amount of that payment that you would have on the traditional loan because obviously the LTV is higher. Also, 40-year loans. Non-QM is more apt to allow a client who has decent credit score to get a 40-year interest-only loan. Now, instead of being amortized over 360 months, now you're amortized over 480 months, which obviously stretches it out and makes the payment lower. And also, it offers you interest-only options that a traditional loan would not offer you. This can give you a 40-year loan with an interest-only option that would really take your payment down so that your monthly check stroke is as low as the lowest interest rates in traditional can offer right now. These are things that you can do to offset that monthly payment hurt that you think that you're going to get, and this will allow someone to be comfortable in their decision making with their loan officer and their company to know that they're putting them in the best possible situation for a mortgage.
Excellent. Thank you very much. Great information. Could you shout out a way by which people can get in touch with you? Great loan officer out there in the Las Vegas market.
Absolutely. You can reach me at that good old 702-328-5191. That's 702-328-5191. Or you can reach me by email at charles@malibufunding.biz. That's charles@malibufunding.boy Isaac Zenith.
Chuck, thank you very much for coming on the show. Always appreciate your information. Very enlightening today. Thank you.
Thanks for having me always, Jeff. Thank you.
Thank you. That's Charles Giscombe from Malibu Funding. I'm Jeff Barton, your voice in the mortgage industry. We'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. We bring to you each and every week some great guests, great people. If you want to see the show, hear the show, there are a lot of different ways that you can do that. We have podcasting, we have YouTube. We also have a terrific website. If you go to themortgagevoice.com, there you can see, hear the guests, some of the shows from our past shows that we've done. You can contact the guests. They have some bios on them. TheMortgageVoice.com. Great way that you can be able to, as I said, continue to contact us without having to be on our schedule, which is KCAA every Saturday and Sunday on Southern California's brightest and best Inland Empire radio station. It's an FM signal as well as an AM signal. And as I said, it pretty much covers a lot of those particular counties, as well as a little bit out into Palm Springs, certainly Indio, some Orange County, and some LA County as well. It's KCAA and MortgageVoice.com. You can go to both of those places and see the show. Okay, I am Jeff Barton. This is The Mortgage Voice. And joining us once again, haven't had Gail on in a while, is Gail Whiting. She does a great deal of processing, but has been in the mortgage business for a number of years, underwriting, all kinds of different, originating, all kinds of different positions, currently working for Malibu Funding. Gail, how are you?
I'm good, Jeff. How are you?
I'm okay. You know what? I would like to solve more problems for more borrowers, but it's difficult when you just get into a situation where either the rate's the problem or the scarcity of properties is a problem or the program's a problem. How are we solving these problems? Give us an idea of what your process is once you get a loan in the door and how you begin to solve the problem of home ownership for this particular borrower.
Well, the first thing is, complete information,
Right.
right? So we can determine the best loan product for them is the best way to go about doing it. So sometimes if you're might be missing a little bit information, it can change the loan product, which can change the rate or a down payment requirement. So I think the way to get a good foot is complete, our loan application has all the questions on there. They're answered correctly, because everything's verified.
Right, of course.
And you're off on a good foot. There's tons of loan products out there, down payment assistance. Sellers are helping buyers with some dollars to buy down the interest rates.
Okay, what do they call that? They call that the 3-2-1 buy down, something like that?
Yeah, and one lender may have a 3-2 buy down. One lender may only have a 2-1 buy down.
Right.
So
explain that product, will you, if you could, please, because it's sometimes a little confusing when people are going, what is 3-2-1 buy down? What is a 3-1 or a 3 or a 2? What does that mean, actually? I know what it means, but explain that to the audience, if you would.
Okay, so basically you're buying down the interest rate, and what the 3-2-1 means is a 3 would be 3 years. You bought down the interest rate for 3 years.
Okay.
Then it goes down to 2 years, and then 1 year. Now, in that amount of time, because the rates are temporarily high, us in the business know this. They're just temporarily high for lots of reasons. You know.
Yep, I do.
Don't need to go into economics here, but so us in the business pretty much taking market ideas professionally, that the interest rates will be down, let's just say next year, right?
Right.
And towards the end. We think they might start decreasing in December, but, they decrease when they'll decrease.
Okay.
And so the seller gives a buyer a few dollars, seller concessions, to buy down the buyer's interest rate. So let's just throw one out there. You got 6.5%.
Yep.
Or 6%. The seller pays basically a point, and it can lower the interest rate for a year. If buyers are forward-thinking, and they can look at the market themselves and hear what, the professionals online and market shows and whatever, how the Fed will be, everyone's anticipating a rate reduction. It kind of helps the buyer on a monthly payment have the interest rate not so scary, when we're talking 6 and 6.5 and such.
So this is an introductory program for a year, 2 years, 3 years, depending on the program you choose, in order to help the buyer get into the property, and they have to qualify for the actual payment when it readjusts to the full payment?
Right.
Okay.
Right. And such. So a lot of buyers are taking advantage of that because they do believe, and I think it's a smart thing to do, to be in a home and ready to refinance that home to a lower rate.
Of course, I agree.
When that interest rate finally shows itself.
Gail, let me ask you another question, if I might, please. In your underwriting duties that you used to work, I believe it was the Bank of America or some other bank, have you seen an environment like this where what we have is really the real estate market really hasn't fallen all that much? As a matter of fact, it keeps going up in some miraculous fashion. Inventory is really low, and we have rising interest rates, or at least steady interest rates, about 6.5%, up from 3%. Have you seen this much cooling in the marketplace? And is that affecting, I guess, the underwriting standards that banks use when giving out mortgages?
Well, I hear that the lenders are going to tighten their guidelines.
Right, that's what I heard too. Right.
Right, and that's just because the Fed has used their last tool of an interest rate hike.
Right.
In other words, the Fed raising interest rates to cool inflation, that only gets that so far.
Right.
So now the Fed is relying that by deterring, people taking out loans and stuff like that due to interest rates, banks will tighten the guidelines, which will less loans help curb inflation too.
Right. So you're talking two different interest rates. You're talking the mortgage interest rate, which is really controlled by the 10-year and some other bonds and
Right.
other factors. And you're talking the Fed rate, which is really short-term interest rates that banks lend between themselves to cover their whatever they need on an overnight basis for their cash. Right. So both of these things, plus the bond buying, I mean, that's another
Right.
thing that the treasuries that they've unloaded from the Fed, I think it's about $60 billion a month that they've been doing, really stalls the market. That and tightening interest rates. So this is what's attacking inflation. Not necessarily the best for borrowers, but it's not the worst either. I mean, obviously, inflation eating into your monthly paycheck is hurting you as much as rising prices in your house.
Right, right. And the feeling of the market is that it's temporary.
Right.
So it has put a lot of buyers on the sidelines, which is kind of good if you're a buyer looking to buy now, because your last year when the rates were such unbelievably low, competition amongst the buyers, you'd list a house and there's 20 buyers wanting to buy that house.
Right.
So, if less buyer competition right now, you might get the home that you really want. It's going to temporarily, in my opinion, a higher interest rate, but you'll be in the home when the desired rate, when you are ready for those interest rates to drop.
Yeah, no, I agree.
Right.
100% I agree. Now, unfortunately, we're up against it, Gail. I apologize for that. Good information, excellent, and want to have you back soon. But could you give people a way by which they can contact you? You have licenses in many states. You're based out in Las Vegas. Maybe shout out your phone number. That'd be awesome.
Sure. It's Gail Whiting, Malibu Funding, 702-503-3252.
Gail, thank you very much for coming on such short notice, and I really appreciate the information. Thank you.
You got it. Thank you.
Thank you, too. That's Gail Whiting from Malibu Funding. I'm Jeff Barton, your voice in the mortgage industry. We'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thank you very much for tuning into the show, for listening to our program. We bring to you information about mortgages. Mortgages is the base of the information that we use each and every week to try to tell you, not tell you, but basically share the information that's relevant, whether you're going to buy a house or you're going to sell a house, maybe even refinance a house, although right now, if you've got a low interest rate, you're probably not going to want to refinance. But if you got a ton of equity locked up in there and you need the money, well, you might want to try a second or a home equity line of credit. There are a number of ways that you can gain access to that particular money. Okay, talking a little bit earlier about several things that are happening worldwide, especially this debt ceiling thing going on locally in the U.S. and how it's going to affect you if it doesn't get solved. Yeah, it's really a problem. Now, if you want this information, you can't access it today, and you want to hear it, you can hear it on a number of different podcasts that we have. And Darryl, you have those podcasts for us?
I sure do, Jeff.
Great.
It's Apple Podcasts, Spotify, Spreaker, Stitcher, iHeartMedia, radio.com, YouTube, and podclips.io.
Excellent. Podclips.io, great place to go. Centralize your podcasting wants and needs. They have all kinds of podcasts there at podclips.io. Certainly me in the financial, there's lifestyle, there's health, there's sports, all kinds of different things. Go there, podclips.io. Again, I'm Jeff Barton. This is The Mortgage Voice. Let's see. So I have a couple of things I wanted to get to in terms of what's happening out there, how a lot of this macro stuff might affect you in your decision-making process. The delinquency rate, of course, we talked about a little bit in an earlier segment of the show at 3.56 of all loans, 3.5% of delinquencies on all loans, and 1.77% delinquency on first month delinquencies, which is, very, very good. Historically, almost low rates. I mean, we've seen this delinquency rate remain low, even through high inflation, even through when we saw low interest rates, obviously, and when we've seen the higher interest rates come in, we still haven't seen delinquencies. Why? Because everybody's got really low rates, or they're very close to paying off some of their old loans that they've had for some time. I know I did that, paid off my loan right before COVID hit. So I was in the 5.5%. And that's another thing. If we get to a range just below 6%, 5.75 to 6% of a 30-year fixed rate loan, I think you're going to see a resurgence in housing demand. Why? Because that's a number that people can deal with. And that's one of the things I wanted to talk about is at what point, I spoke about this last week too, at what point does the interest rate, that you get used to it, that, hey, it's not too bad. Hey, I think I can afford it. You know what? I'm making enough on my job. I think I can do all right. Brings me to another point. We've seen a 20% increase in salaries across the board since the beginning of the pandemic. That's the last 3 years. Salaries, wages have gone up 20%. Now, people will say, well, inflation. That's killing me. And that's why I can't go out there and afford it, because I don't want to know if inflation itself is going to continue to tick up. Well, we talked about it. Inflation is at 5.1%, something like that. The producer price index came out yesterday, and that number is actually looking pretty good. The producer price index is at, I believe, 2.3%. Now, that 2.3% represents what wholesalers buy in order to manufacture and then sell to the consumer at the consumer price index. So 2.3% is really a fall in that. And one of the reasons is, I think I talked to you about it a little bit, the egg price dropping, 37% last month in April really brought a lot of that number down, a lot of the big number. But what are some of the other inflationary numbers that we should consider? Now, the thing to remember in any of this comparison is that wages have gone up 20% over the last 3 years. So if we have anything below 20% that these goods have gone up, that's a net positive for you, the consumer. Let's get right to it. Okay, income up 20.2% since 2019. Rent up 20%. Housing, 20%. Personal care up 16.8%. So that's a net positive for you. Hotels up 14.2%. Net positive. Healthcare, 10.9%. Airfare, 9.6%. Education, 9.4%. These are all positives for you. Now, some prices have not risen at all, have actually decreased, which means for instance, electronics have gone down 3.6%, which means that your 20% raise over the last 3 years, you're way ahead if you want to buy electronics. It's a great place. Toys are the same thing. Now, in the reverse, things that have actually continued to climb way beyond your 20% pay raise are things like rental cars. You rented a car anywhere? Travel in general, restaurants in general, used cars, gas, housing, household energy, food, restaurants, new cars. All these things have gone up between 21 and 51%. And that's all an increase, even with your wage increase. So what does this mean? This means that on certain items, if it's oil related, it's going up. Anything having to do with gas or cars or any kind of fuel related thing, all those prices are setting things way high. Now, usually that means we've also seen a rise in food prices. Food prices have gone up 25%, which means you're down 5% on food prices if, in fact, you're looking at that 20% pay raise. So that's just some of the things that we're looking at that we see that are really not good in terms of the inflation, but those things that are good are the things that are obviously less than the 20% raise, which means that you're a net positive on those items. Now, why is this important? Because you have to figure every time that you buy a house or sell a house that you've got expenses included in that, and also the weekly, the daily, the monthly expense of owning a home. What is it? How it might change if, in fact, inflation goes up or salaries go down. These are things that might happen if, in fact, we get a recession, which has been predicted, and I, too, think a mild recession is coming in Q3 or Q4 this year. If we get that, people are going to be afraid because they might lose their job, and also that those things may affect prices going up. We see that housing prices haven't changed all that much in the last 6 to 8 months, meaning that we still have an increase in housing prices over that time period because there's no inventory and the low interest rates that were around for 3 years. A lot of people have bought when it was exactly that price. There's no reason for these people to get out of that low interest rate mortgage and move somewhere else where they're not only going to have to pay more for the house, but they're going to have to pay more for the mortgages. And nobody wants to do that, which is why we have such a tight inventory in the market. Now, we may see, as I said earlier in the show, we may see mortgage rates come down a bit. We've seen it come down in the last 2 or 3 weeks, and depending on what happens in the debt ceiling, depending on the CPI and the PPI over the next 2 or 3 months, and that would bring us to the middle of the year, we might see some, ability by which the borrower can get out there and buy a property because those things have changed. But if there's nothing, as I read earlier, if there's nothing on the shelf, there's nothing you can do to buy that particular property. Couple of companies not doing so well. A lot of these companies in the mortgage business, Loan Depot, big losses in Q1. Guild Mortgage, $37 million loss in Q1. United Wholesale, losses double in Q1. And Blend Mortgage reduces losses by narrowing or increasing the margin on each and every loan. When someone says increase the margin, you know what that really means, right? It's going to cost you, the consumer, more money. If a company says, hey, we're doing better on the bottom line, it means you, the consumer, are paying more for the product. Just how it is. So when we're rooting for certain things to do a certain way, remember, every dollar taken out of your pocket is a dollar you can't spend on a house. And that's a real big issue, especially right now when we've got inventory, as I said, really low, and we've got mortgage rates still pretty high. Anyway, I'm Jeff Barton. I am happy to have had you here on the show today, and come back next week and we'll have some more great information. This is Jeff Barton, the Mortgage Voice. We'll see you next time.
You're listening to The Mortgage Voice with Jeff Barton. For more on today's topic, visit www.malibufunding.net.
We supply the words. You paint the picture. KCAA.
The message of Brother Stair lives on here in Southern California on KCAA, Monday through Friday from 1 to 5 a.m. Hear the worldwide broadcast of the Overcomer Ministry from the Faith Cathedral Fellowship. Call for prayer requests or to make a donation at area 843-599-1215, beginning at 1 a.m. Monday through Friday. Hear it here on KCAA, AM and FM.
Bitcoin. Most of us have heard of it by now, but do you really understand what it is? What about money? Where does it come from and what gives it value? Money is changing, and today it's just like the early 1990s. The internet is here, but very few people understand what is about to happen. Don't get left behind this time. Tune into Cryptocurrency with Matthew J. Moore and listen to America's Bitcoin-focused radio show every Monday at 7 a.m. right here on 106.5 FM or 1050 a.m. KCAA.
This segment sponsored by the generous support of the Dream Team. Looking for the keys to something bigger and better? Downsizing or relocating to the perfect spot? Oscar Ramirez from Century 21 Lois Lauer Real Estate and Matt Flores from Secure Choice Lending are here to help you sell or buy with their trusted and experienced knowledge and advice. People are calling Oscar and Matt at 951-751-3249. That's 951-751-3249. Real estate and loan advisors Oscar and Matt can give you a no-cost consultation. You don't have to buy anything. Matt and Oscar can help you figure your way through the complicated real estate market. Email Oscar at loislauer.com or on Instagram at Oscar Ramirez Garcia and Matt Flores at securechoicelending.com. Don't let today's real estate pitfalls stop you from dreaming. Make your new home dreams come true. DRE number 0207-0344. Se habla español.
The Tri-City Shopping Center in Redlands is serving up some really cool ice cream at La Micho Acana. Then get your chocolates and other delights from C's Candies. Moms and future moms who visit the mall can cool off and relax while they get treated like royalty at Shiny Nails or Francis Nails and then pampered at Texture Hair. The Tri-City Center is filled with retailers who care about you. Shop at the Tri-City Center in Redlands and see why they call it the mall with a heart.
This segment is sponsored by PressPrint, Southern California's best full-service union printer and mail house. They offer the lowest prices around with unmatched service and reliability and free delivery throughout SoCal. PressPrint can print anything from letterhead, business cards, and campaign literature to mailers of any size, lawn signs, banners, door hangers, or just about anything you might want. PressPrint promises to save money for you, your business, or your campaign. If you'd like to learn more, contact Mike Kroonbrand at PressPrint 714-399-8708. Get the union bug.
Hey y'all, Merle here. Good news. For once my neighbors is jealous of me. You want to know why? Because my grass is growing and looking green, and I can sit on my sofa out in the front yard, and I don't even have to overwater it anymore. You know how I did it? I listened to Damn Water Boys on the Water Zone every Thursday night on KCAA. Well, I got me a smart controller, and now it waters at night, and my yard looks darn tootin'. No more sneaking around and hooking up my hose to my neighbor's spigot in the middle of the night, and his dog won't bite me anymore. And you can do it too. Listening is easier than ever. KCAA is now streaming online.
It's streaming.
What?
It's streaming, you dummy.
Well, I don't know much about streaming, but they doing it apparently at KCAAradio.com. So anywho, listen to the Water Zone and fix your yard up right here at KCAA, the station that leaves no listener behind.
KCAA Radio has openings for 1-hour talk shows. If you want to host a radio show, now is the time. Make KCAA your flagship station. Our rates are affordable and our services are second to none. We broadcast to a population of 5 million people. Plus, we stream and podcast on all major online audio and video systems. If you've been thinking about broadcasting a weekly radio program on real radio plus the internet, contact our CEO at 281-599-9800. 281-599-9800. You can Skype your show from your home to our Redlands, California studio where our live producers and engineers are ready to work with you personally. A radio program on KCAA is the perfect work from home avocation in these stressful times. Just type KCAAradio.com into your browser to learn more about hosting a show on the best station in the nation or call our CEO for details. 281-599-9800.
NBC News Radio, I'm Tammy Trujillo. President Biden is hinting at some progress in weekend negotiations to raise the debt ceiling. Biden spoke briefly with reporters on Saturday after giving a commencement speech at Howard University and said there are real discussions about a deal, but we're not there yet. When asked if he believes a deal can be made by June 1st, the president said it has to be. Republican presidential candidate Nikki Haley isn't taking sides in a recent lawsuit involving her party's frontrunner.
Anyone that feels like they have been sexually assaulted in any way should come forward and have their voice heard. I also think anyone that's been accused should be able to defend themselves.
When asked on CBS's Face the Nation about former President Trump being found legally liable for